Thank you all for coming today and listening to us. My topic today is investing in turbulent times, and I don't really have to tell you how difficult investment markets are out there. My colleagues have shared with you many of our thinking that we apply inside our funds and how they think about risks and opportunities to deliver inside the funds. I'll sort of take one step outside and talk around the funds and how you as financial advisor, asset consultant or trustee can use that in your life to make a difference in your clients' lives. Now, we've touched on some of these things, but in South Africa, we have numerous challenges and we are struggling to search for investment opportunities. I don't have to tell you more about these challenges. The newspapers are full of it. Your clients tell you lots of that. In terms of the markets, I had a look at what does the investment markets, why are people so negative and what has it delivered? So I took a rolling 7-year return number of the average balance fund in blue compared to the average income fund in that pink color. And clearly what we've seen over the last 3-4 years on a long-term basis, think about a fund fact sheet, you look at a rolling 7-year return, for the last 3 or 4 years, your average balance fund has underperformed fixed income, which in my mind we call the abnormal situation. But effectively, your client comes to you and put a lot of pressure on you. Why should I take this additional risk when I'm not getting rewarded for that? And that's a very, very difficult question to answer. The one thing I can point out, we have seen this before. And it is, while it is very, very difficult to stay the course when that happens, typically the recovery out of that period is very rapid, as you can see the steep lines going up. And the outperformance, the reward towards your client in terms of additional performance is actually quite significant post that. So I thought, what can I do today and talk to you? And I think this picture best describes it. There are many things that matter to your clients in terms of investment returns, but you can't control or influence a lot of that. But there is an intersection between what you can control and what really matters. And typically, I find in my life at least, that is where I try to focus my attention and all my energy and time to see if I can make a difference. So how does that portray to your lives? Looking at flows over the last number of years in South Africa, I've grouped together the flows to all the fixed income funds and compared it to all the multi-asset funds, i.e. a bit higher risk funds. In green, fixed income, so for the 6 years ending 2016, you would see what I think is sort of the normal situation, most money going into your multi-asset funds, conservative balance funds, and sort of less towards fixed income, more of your short-term money. But that picture has changed severely post-2016 and has accelerated post-COVID. So that is R500 billion that has moved into cash on a net basis, all in, less, all out. So that money is sitting in waiting in cash. What are we waiting for? Obviously, as your client tells you, no, let's just put this money in cash. We wait for the markets to recover a bit and then we move. Have you heard that before? Yeah, never. That money is sitting in cash, and while Rena has shared with you the great returns on offer in fixed income, I'll speak a bit later to you about the returns required by clients, particularly in living annuities, in order to ensure those remain able to pay fixed income. So this is, in my mind, a picture where you as financial advisor or asset consultant or trustee can make a material difference in your client's life. So what I look at various research around the world, I found this study is a Canadian value of advice study. They try to do two things. They try to quantify what is the value of advice to a client. And they try to quantify it to say is when there are a group of clients who get no advice versus a group of clients that are advised, what are the differences in their total assets under management over various points in time or years in time? And in the block, I've put that, so I'll just take that middle scenario. Effectively, they're saying for a client that received advice for between 7 and 14 years, their assets under management are roughly 1.99 times, i.e. double the assets compared to the cohort of clients who didn't receive advice. And obviously, the longer you take that, the higher that multiple becomes. Then importantly, they had a look on to see what are the factors that drive that. So clearly there are things that you help your client save more, you structure it more tax efficient. But that middle one struck my eye, which effectively says they play a critical role in better portfolio allocation, i.e. the allocation of assets into non-cash investments. Think back the previous slide. The allocation of assets into non-cash investments. There's a R500 billion opportunity for you there. And also the bottom one is obviously helping your clients stay the course, better client discipline during especially very, very difficult investment periods. The next thing that I thought about, I've got this thought in my head that clients, when they save throughout their lives, they typically save in their retirement annuities and balance funds, but when they get to this point of retirement, there's a massive de-risk that happens. So I went to a few of my colleagues who work at the largest LISPs in South Africa, and I say, can you provide me with some data from your LISP? Take your entire RA book, your retirement annuity book, i.e. pre-retirement, and slice that up per CISA category. And then you do the same with your living annuity book, i.e. your post-retirement book, and slice it up per CISA category. Then I can compare it. And the picture effectively looks like this, with the RA book in the pink color and the living annuity book in the purple color. The biggest thing you can see there is in the RA book, more than half of the assets sits in balance funds. And at that point of retirement, that effectively halves. And it moves to other multi-asset funds, lower risk, and some offshore. Also, that 14 to 10% out of equity in real estate, that's actually not an unmeaningful movement. What we then did is to say, can I quantify this? We did it in two ways. We took all the historical returns since inception of all of these categories, and we calculated what would be the historical return difference be if the assets looked like this. And I also went to David and his team and I say, on a forward-looking basis, what would each asset class pay us? On that killer slide he showed you, and I apply that to these funds. And the answer that I can come up with is effectively a 0.8% difference in return. I.e., when clients move post-retirement, they de-risk to expect a return of 0.8% less. Now, you might think 0.8% less is not really material. And what I did is I had a quick look, is if you retire at 60 with a certain amount of money and you do your living annuity modeling, and you then do that same modeling with 0.8% less return, the answer effectively says you run out of money 28 months earlier. Okay, imagine I take 28 of your paychecks away. That is significant, in my mind at least. I won't survive. However, the thing that was more alarming to me is I calculated in that same exercise, so what would the total expected return be of these two books? And I got to an answer of 4.85% real return on the RA book and 4% real return on the living annuity book. That difference is the 0.8%. In my mind, both of those are too low. This is after fund fees, but this is before platform fees, advisor fees, and that other thing called client behavior. Think about the numbers you plug into your modeling and if they are at this level. So getting quickly back to client behavior, I'm not going to talk about that today, but I've updated a slide that you've probably seen. I've taken the 10 biggest multi-asset funds in South Africa and we do two calcs on them. One is what did the fund deliver, which is in the green bars, compared to the weighted average return that the clients invested in those same funds earned. That's the money-weighted return. The difference on all of them, clients earned less than what those same funds they invested in deliver. On average, that difference is 3.1% per annum. Now again, quantifying 3.1%, 60-year-old living annuity, do your modeling, take away 3.1%, you run out of money 12 years earlier. That's 84 paychecks. That one my wife won't survive. That is quite significant. So if I take that 3% difference, and maybe let's just add 0.5% in terms of cost, and I add it into this picture, then maybe the clients don't even earn those 4.8% and 4%. Maybe if I take the 3.5% away, they only earn 0.5% real or 1% real. Now, if you think my analysis is ridiculous, you're welcome to do so. I saw a study recently from one of the oldest LISPs in South Africa. And it went they announced this and there wasn't a lot of press about it, but I thought it was quite significant. They did an internal rate of return calc on every single client on their platform since inception of that client. So this is now, what did the clients earn after all fees, cost, whatever behavior they did? And the answer that they came up with is over a 25-year period, 80% of their clients did not match inflation, i.e. they earned less than inflation. So my picture, I would argue, is actually quite conservative still. Right? So this is the bogeyman we're all trying to beat. And that's what I'm thinking of, how can we help you outperform inflation and client behavior? So I just took our two biggest multi-asset funds, invested in these two categories, and I took their return since inception, which is 21 and 24 years old. And I said, if you invested R1 million in those funds 20 years ago, that million should have grown to 2.7 million just to keep up with inflation. Okay? Then, to keep up with the average fund in each of those categories, they should have grown by that. So the balance fund should have grown to just over 8 million, by way of an example. But they actually did a bit more. They grew the balance fund to 11 odd million and inflation plus to 7.2 odd million. In the balance fund's case, that's more than 7% real above inflation. That is a significant return. You can put your money in there and keep it there. That's what happens with my pension fund, entire pension fund in the balance fund, and in fact, every single employee at M&G Investments. That's where their retirement fund sits. And in the case of inflation plus, 5%, more than 5% real. I would also remind you that's the A classes. Less than 10% of the assets sits in the A classes. All of you are invested in the platform classes, which is 60, 70 bips, still cheaper than that. So would deliver more return than that. The next thing I wanted to look at, and I'll explain this graph in some time, is to say, how long does your money last in a living annuity? Now, normally what we do is we take one client and I do a projection on a base of some set of assumptions. And I said, maybe that is great, but not the real world. So what we said is to say, take those ASISA fund categories, go and take their actual experience, return and risk since inception 20 odd years ago. Then you take a cohort of 20,000 clients and run it through a living annuity simulator, taking 2.5% drawdown rate, earning the returns in each of those categories. And then I said, what is the probability that that client is going to run out of money? So we formulated a thing called a failure rate. And the failure rate says the pot that is left is less than 2 years' worth of income. You agree with me? That's sort of your tickets then, right? So you can't take it longer because the percentages doesn't work. So on a 2.5% drawdown rate, you effectively see the failure rate across all categories is 0. So all clients make it. Clients don't run out of money. Interestingly, think about the logic. In the case of the equities, over 40 years, there's a 1.7% failure rate. Is if you take all the worst years of performance that we've had over the last 100 odd years, and you all earn put them right up front next to each other. So you get all the worst years, one after each other, and then there is a chance that you can fail, but it's 1%. Then I said, okay, that's a 2.5% drawdown rate. What happens if we put a 5% drawdown rate into this picture? And that's what happens. A significant increase in what I call a failure rate. And think about the logic. After 10 and 15 years, things stay at zero. Effectively, you can put your money under the mattress. If you draw 5% for 20 years, it's roughly 100% of your capital is then gone. Right? So in the early years, everything performs well. Fixed income is particularly nice and smooth, but then all of a sudden, it's like our coal plants, they fall off a cliff. You go to zero very quickly. Right? But your higher risk funds then deliver the returns that keep you there. And then I thought, well, what the hell, since I'm playing with this, let's put 7.5% drawdown rate in. And effectively, the picture on the screen tells me at 7.5%, failure is guaranteed. And then I thought, is this a ridiculous assumption? Again, I went to my LISP friends and say, what is the average drawdown rate of a living annuity on your LISP? And the number is above 7%. So this is the problem that we are facing. And living annuities only start in the mid-90s, so 20, 30 years later, you can now think where we are going to start to play. You guys see this often. Again, what can we do to help here? And I'm just offering some ideas. Obviously, you'll have many ideas of your own. This is the 5% picture again that I've just shown you. And I said, if I take the M&G funds in each of those categories and I plug it in and I run 20,000 simulations on each of them, how does that picture look like? And the picture is effectively more green. So maybe by way of an example, if you take inflation plus, which is in that multi-asset low equity category, after 40 years, there's a 66% probability of failure rate, but if you only went into inflation plus, that drops to 20%. That is only 20% then of the clients fail instead of 63, 66%, which in my mind is significant. But, okay, that's interesting, but why? So we then did an analysis of why this is the case. And I guess the best way to show this to you is to look at two things. The one is risk and the one is return. On the return side, if I take inflation plus as return since inception over 20 years, and I take the rolling 3-year returns and I compare it with bonds and equities, just the all bond index and all share index. Effectively, inflation plus gives you an average 3-year return roughly between cash and bonds, bonds and equities. But more importantly, it does so at a third of the risk of equities. And by plugging in those extra returns, help those failure rates, but massively reducing the standard deviation, i.e. the volatility in your return, has got a material impact on those failure rates. And again, the same picture just on the balance fund. Effectively, this is a high growth fund. We're trying to outperform equities, which the fund has done. And again, that's the A class, the platform class, which would be much better. If I can outperform equities at much lower risk, and that is in fact the case, it's about 40% less risk than equities. And that less risk make a material impact on living annuities. We always think about the return side of things, but the risk side of things are also quite important. And I said, okay, if I put that back into the failure rates, by how much can you reduce your failure rates of the average fund that I've shown you by investing in the M&G funds? And I thought if we can reduce it by 10 or 20%, we'll probably make a material difference to your clients' lives. And the answer is effectively this. So again, if you take the inflation plus fund, let's say at 25 years, reducing the failure rate of that living annuity by more than 50%, over 25 years going to 70% reduction in failure rate. And in my mind, that is a material difference. If we can help deliver that for your clients, I think we've done a great job, and we would love to help your clients with that. So from my side, that is just a few thoughts in terms of how we can assist, in terms of what you try and deliver to your clients on a daily basis. Please feel free to chat to us about. We don't have all the answers, but we try and do research to help you with what you guys struggle with on a daily basis. Thank you very much for your time.